Hello again, everyone. It is 8 o'clock in the morning, Chicago time on Monday, May the 8th. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially through the first half of 2023. Let's follow the money. In our previous Your Daily 5, which was about 2 months ago to the day on March the 7th, I said that S&P 500 stocks were at a major decision point and they were leaning higher. That major decision point was 3,900. It was underlying support in the S&P 500, and the S&P 500 had risen since then to test the 4,200 area, which we're going to take a look at in just a minute. Since then, it's been really clear, especially over the past several weeks or so, that the S&P 500 doesn't know what to do here. The market, I should say, the collective wisdom of the stock market is not sure of what to do here. I think that's for a lot of reasons. We still have a lot of folks out there that are worried about inflation and worried about an upcoming recession. There's another contingent out there of very smart people that think we're in for a soft landing. The Fed is through raising rates, and this is going to create an opportunity for a lot of sideline money to come back into the market and fuel another sustained move higher in the U.S. stock market. Then we've got the financial issue with the banks. We've had some bank failures here. There's one side that thinks that these are one-offs and that this is not a systemic problem. There's another side that thinks that this is the tip of the iceberg and there are threats of a systemic banking problem that are in the offing in the months ahead. And finally, we've got another debt ceiling to deal with in just a few weeks, and Congress looks like they're going to play chicken with that again, and with that, the full faith and credit of our treasuries. So there's a lot of turmoil out there, and you can see it in the market. So let's get started. Number 1, the S&P 500 investor indecision since December. So here we have the S&P 500 daily since October of last year, and we have the 200-day moving average in orange, which is the major trend. We have the 50-day moving average in blue, which is the minor trend proxy. And the most important annotation on the chart here is this rectangle, bordered by 4,200 on the upside. That's the February 2nd high. After we initially broke out of the 200-day moving average, broke out higher, we stopped right here on February 2nd. On March 13th, we came all the way back to those lows that we made at the very end of last year. Here on March 13th, and now we're bumping up against 4,200 again. All of this is indecision. It's very clear to me by a number of different metrics that we're going to look at in just a second that the market isn't sure of what to do here. And when it's not sure, the ranges compress and people stay inside the lines where it's safe. Right now, it's safe between 4,200 and 3,800, and nobody really wants to step out into the street so far. Let's take a look at number 2, which is market internals. The Asbury 6 is dead neutral. The Asbury 6, if you've been following me on the internet or some of the media outlets that I have seen in, you'll know the Asbury 6 is one of 2 tactical models that we have here at Asbury Research that try to tell us what the internal condition of the stock market is, because you can't tell by looking at the S&P 500 anymore. I've been doing this for a long time, and back in the day, if you had volume and an S&P 500 chart, a couple of trend lines and some moving averages, you could tell back of the envelope what the condition of the stock market was. Those days are gone in my view. So what I did years ago is I started back testing my favorite tactical tools. Stuff that I used to tell me what the internal condition of the market is. Started back testing them in sets of 3, in sets of 4, in sets of 6. trying to find a group of them that would work well with each other. By working well with each other, I mean when one or two are giving us a false signal, because no indicator works all the time. If one or two are giving us a bad signal, the other ones would pick it up and keep me informed as to what the internal shape of the market is. It's very similar. I use the metaphor when you go to the doctor's office for your annual visit. He sits you on the table and he starts checking your pulse and checking your reflexes and checking your blood pressure. There's about 6 of those, just like there are 6 of the Asbury 6. And it gives him a baseline indication of what your health might be. That's what the Asbury 6 does. Look where it is right now. It's dead, flat, even. 3 are positive. The rate of change, and this is set up to the month. 21 business days is Asbury Research tactical time period. So this is very tactical. This is monthly. The top 3 here, the rate of change, relative performance between stocks and high yield bonds, and investor asset flows are all positive. Look, they're all positive as of May the 4th, the very end of last week. And then there are 3 that are negative. Corporate bond spreads, trading volume, and market breadth. These are only negatives since May the 2nd. So what we have is this churn going back and forth. That churn that you see on the charts is being shown here in these indicators that are looking under the hood of the market, so to speak. So it's verifying what we're seeing on the price chart in the S&P 500. The market doesn't know. These indicators are moving back and forth between green and red, positive and negative, and right now they're balanced. When the market does this, or when the Asbury 6 does this, we call it blinking. And that blinking typically leads to the next tradable trend. Look at this blinking here in August, mid to late August. It's actually late August of last year as the S&P 500 was testing the 200-day moving average. We had down, up, down here. What we call a down, up, down. There was blinking here. It was going back and forth. This was the springboard for this big move all the way back down to the October lows. So we think the market is coiling for another sustainable move. We don't see the direction yet. And when we do, it'll probably show up first in the Asbury 6. But right now, this is basically corroborating what we see in the price chart of the S&P 500. Number 3, sector rotation. The SEAF model is defensive. SEAF is one of our models that tell us where to be invested. And the SEAF model, I built the first version of this more than 5 years ago, and I did so because sector rotation had really sped up. It wasn't good enough anymore to look at the charts and see what the relative performance versus the S&P 500 look like in the sectors of the S&P 500. I needed something quicker. So I said, let's try, instead of following relative performance, let's try following asset flows. Those asset flows should actually generate the relative performance that you see on the chart. So that's what we did here. We developed a methodology to measure the velocity of money moving in and out of the 11 sector spiders, which together represent the S&P 500. And then we came up with a ranking system. And the best ones, the ones with the biggest, fastest asset flows that were moving into that sector, those were rated on top. 1 being the best, 2 being the second best, and so on all the way through until we get to number 11. 10 and 11, which you can see are marked here in red, those are the ones where the money is leaving those sectors the fastest. So we did that in 3 different time periods: trading, tactical, and strategic. And then we look at them and rank them 1 to 11. So right now, through the end of last week, the 3 best ranked sectors, in other words, the ones with the biggest percentage of asset flows going into them, are all defensive sectors. Number 1 is consumer staples, XLP. Number 2 is healthcare, XLV. Number 3 is utilities, XLU, all the way across. The rankings, by the way, biggest percentage of inflows during the period shown. The favored ones are from 3 to 15. The neutral ones are scores of 16 to 24. You can see those are yellow. The favored ones are green. The neutral are yellow. And the avoids are with a score of 25 to 33. Those are red. The two worst ones right now are real estate and energy in terms of assets leaving them. But there's another nuance to this table that I wanted to point out real quick. That's that the next three best, after we get through these first three defensive ones, are all offensive. Technology, communication services, and consumer discretionary are generally offensive risk-on sectors, and those are right after these first three negatives. What I've been noticing is that this model has been flip-flopping between positive and negative sectors for a good part of this year. That is very atypical. Typically, we will get into a sector and stay there for a long time. Last year, the SEAF model got into energy on January the 10th of last year, stayed there till the end of June. Big trend, made a lot of money on that one. That's not happening this year. The money is sloshing back and forth, kind of desperately grabbing towards offensive ones, and then it goes to defensive. That shows us just what we've seen on Asbury 6 and just what we've seen on the S&P 500 chart. Indecision right now. It's all over the board. We can see it. Here's number 4, relative performance. The CARP model is leaning positive. The CARP model, like the sector model, our SEAF model, is another one of our models that tells us what parts of the market to be invested in. And what we did here is we looked at 8 relative performance comparisons that have to do with equities, like stocks or bonds, large cap or small cap, growth or value, and then we have 3 that have to do with fixed income here on the bottom that we're not going to talk about today. But what we're seeing here, and what these arrows point out, is that just over the past several weeks, we're seeing a slight lean toward what I would see more risk-on relationships, stocks over bonds in all three time periods, broad market over blue chips. In other words, SPY versus the Dow 30 or DIA is the ETF. The broad market is outperforming the Dow. Usually the Dow will outperform when a defensive environment is here. The next one, technology over the broad market. Technology, again, outperforming the S&P 500, QQQ that is, outperforming SPY on all 3 time periods. Look when this trend started. This trend first showed up in the CARP model on January the 20th, and since then, the Qs have outperformed SPY by almost 10%. So this early on told us that we should be in technology. And then finally, growth over value. Growth has been outperforming value on a strategic basis since January the 26th. That's been another good trend for us. While the market is banging around sideways in that tight range, CARP has highlighted some very good relative performance traits for us, so we can dance between the raindrops a little bit while the market is figuring out its bigger trend. So right now, again, this is leaning slightly offensive towards the risk-on sectors. Number 5, and this might be the most important chart that I show you today, market leadership. Apple is vulnerable to a bearish reversal. Here's Apple daily going back to the beginning part of 2021. What I want to point out here, Apple has had a monstrous move here, which has driven tech. It's been a very narrow market. Tech has really been what's driving the market higher. A few big cap stocks largely have been really driving what strength that we've seen so far in 2023. Here's the January 3rd low. And you can see we've got this almost parabolic move higher here from the Jan 3 low. But what I'm paying attention to here is we have 3 highs here. We have the high from October 17th of last year, and then the highs from March and Jan also of last year, 2022. They start at 176.15, which is about 1.5% above the market, and they stretch all the way up to 182.94, which is about 5% above the market. Big resistance, walls of resistance. This is like a fortress of resistance here. Very typically, very unlikely for the market to blow through all of these, for Apple, I should say, to blow through all of these without some kind of a correction first. And because there's so many of them, there's such a strong resistance wall here, this could really result in a meaningful reversal, just to, if anything else, just to take us back to the mean, maybe take us back to the 200-day moving average here in orange. But what that tells me is all the leadership this year, for the most part, has been coming from big cap tech. This is the poster boy for big cap tech. Microsoft, which we're not going to show today, is also testing a really important previous high. So if we lose Apple, if we lose Microsoft, what happens to the rest of the market? Is something else going to go and pick up all that horsepower that we get from Apple, or are we going to slide away from 4,200 in the S&P 500 and move back towards the bottom of that range? That's the question. So basically, a lot of tumult in the market. The market doesn't know what to do here, and its leading proponent, which has been big cap tech, is about to run into a brick wall. So our feeling here is you sit tight, don't make a lot of directional bets, but rather look for these relative performance trades as highlighted by the CARP model to see if we can at least pick up some relative performance while the market is churning and trying to figure out what its next big trend is going to be for the rest of this year. So there you have it. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. You can use the contact tab on our website to request additional information. You can also subscribe to Asbury Research's YouTube channel, free of charge, to get access to more of our work, including our Follow the Money podcast, which, by the way, we just did one yesterday on Sunday, and that's available on the YouTube channel right now. Thanks for watching, and I'll see you again in just about a month.